Diane is 47 years old. She lives in North Carolina. She makes good money. She's been investing for over a decade. On paper, her portfolio looks solid. She has $400,000 spread across 9 different funds: a growth fund, a tech fund, a total market fund, a dividend fund, a couple of sector bets she picked up online, and 3 more she honestly forgot she even owned. Diane thinks she's set. She thinks she's diversified. But here's what Diane has never once done. She has never calculated what her portfolio actually pays her every single month. So she sat down and ran the numbers. $400,000 across 9 funds. Her blended dividend yield? About 0.9%. That means her portfolio pays her roughly $310 a month. After more than a decade of saving, her money pays her less than $80 a week. And she's not alone. Most investors obsess over the big number, the total, the portfolio value. But the number that actually matters in retirement is not how much you have, it's how much your money pays you every single month without selling a single share. By the end of this video, you'll know exactly which 3 ETFs could build a retirement income stream targeting $1,500 a month. And the third one, the one the thumbnail didn't show you, that's the one that fixes a blind spot most investors don't even know they have. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's fix Diane's portfolio. ETF number 1, the growth engine that also pays you. Here's the first thing Diane got wrong. She had 4 separate funds all doing the same job: large cap growth, tech, total market, blue chip. They all held Apple. They all held Microsoft. They all held Nvidia. She was paying 4 sets of fees to own the same companies 4 times. That's not diversification. That's duplication. And duplication quietly bleeds money every year. Here's ETF number 1, VOO, the Vanguard S&P 500 ETF. One fund, about 505 of the biggest companies in America: Apple, Microsoft, Nvidia, Amazon, Alphabet. If it's a major U.S. company, it's probably in here. The expense ratio is 0.03%. That's $3 a year on every $10,000 invested. Diane was paying roughly 0.40% across her 4 overlapping funds. That's over 13 times the cost for essentially the same stocks. Now, here's what most people don't realize about VOO. It's not just a growth fund. VOO has paid a dividend every single quarter since it launched in 2010. It never once cut that payment, not even during the 2020 crash when the world shut down. Over the last decade, its total return has averaged roughly 13 to 15% per year. But here's the part that should make you pause. Right now, the top 10 holdings in VOO make up over 35% of the entire fund. 10 companies out of 505 are driving more than a third of your returns. That sounds scary. It's actually the opposite. Those 10 companies generate free cash flow than some entire national economies. You're not overexposed. You're concentrated in the most profitable businesses on the planet, and you're getting all of them for $3 a year per $10,000. One fund replaced 4 of Diane's holdings. Lower fees, same companies, better results. So VOO builds the number. It's the growth engine. But a growing number that doesn't pay you is just a scoreboard. The second ETF turns that scoreboard into a paycheck and raises that paycheck every single year. ETF number 2, the fund that gives you a raise every year. For years, people were told the same thing: stocks for growth, bonds for safety, the classic 60-40 split. Here's the myth: bonds are the safe part of your portfolio. Here's the truth: over the past decade, the total U.S. bond market returned roughly 1.5 to 2% per year. Inflation ran higher than that for most of those years. Bonds didn't protect your purchasing power. They quietly shrank it. $1 you put into bonds 10 years ago buys less today than when you invested it. So here's the question: what if you replaced the bond piece with something that pays you more, grows that payment every year, and still gives you quality companies? That's SCHD, the Schwab U.S. Dividend Equity ETF.
SCHD holds about 100 companies, but not just any companies. It screens for 10 or more consecutive dividend payments. Then it filters for strong cash flow, low debt, high return on equity, and a track record of growing dividends. Only the strongest make it in. The expense ratio is 0.06%, almost free. The current yield is roughly 3.3 to 3.5%.
And here's the number that changes everything. SCHD has grown its dividend at roughly 10 to 11% per year over the last decade. The payout has roughly tripled since the fund started paying dividends, and it has never been cut, not once. Now, here's a concept most finance channels never mention. There's a moment in every investor's journey called the dividend crossover point. That's when your quarterly dividend payments exceed your quarterly contributions. Your money is now growing faster from its own income than from anything you're putting in. Think about what that means. You're no longer the engine. The dividends are. For most investors using this 3 ETF system, that crossover happens somewhere between year 8 and year 12. After that point, compounding takes the wheel. And here's what keeps the quality high year after year. Every March, SCHD runs a full reconstitution. The index reviews every holding. Companies that have let their fundamentals slip get removed. Stronger companies take their place. It's like a self-cleaning filter for your income stream. You don't have to watch it, you don't have to manage it. The system does the work. Before I reveal the mystery third ETF, drop a comment right now. How many funds are in your current portfolio? 3, 10, 25? I read every single one. So now Diane has growth with VOO. She has income with SCHD. 2 legs of a 3-legged stool. But there's one blind spot left, and it's the one that catches even smart, disciplined investors off guard. ETF number 3, the mystery pick nobody talks about. Here's a stat that surprises most investors. Over 85% of broad international ETFs have underperformed the US market over the last decade. Not by a little, by a lot. So most investors do one of 2 things. They skip international completely, or they throw money at a broad global fund and hope for the best. Both are mistakes. Skipping international means your entire retirement depends on one country. The US market is incredible, but putting every single dollar into one economy isn't diversification, it's concentration. And the broad global funds, they hold thousands of companies from dozens of countries, including the ones that have gone nowhere for years. You get the whole world, including the parts that drag your returns down. Here's the fix. You don't skip international, you screen it. The third ETF is IQLT, the iShares MSCI International Quality Factor ETF. IQLT doesn't buy every international stock it can find. It filters for quality, high return on equity, stable earnings, low debt, the same quality philosophy that makes SCHD work applied to the best companies outside the United States. And the names might surprise you. Nestle, ASML, Novo Nordisk, Roche, SAP, these are some of the most profitable businesses on the planet. You probably use their products every single week without thinking about it. The expense ratio is 0.30%, higher than VOO and SCHD, but you're paying for the quality filter that keeps the low-quality companies out of your portfolio. And here's why timing matters right now. Quality international stocks currently trade at roughly 13 to 14 times earnings. US stocks trade at roughly 21 to 22 times earnings. That's one of the widest valuation gaps in over 2 decades. You're buying world-class companies at a meaningful discount to their American peers. This isn't diversifying for the sake of a checkbox. This is buying the highest quality companies on the planet at cheaper prices than you'd pay at home. 3 ETFs, 1 system. But does the math actually land on $1,500 a month? Let me show you the numbers, and one of them surprised even me. The $1,500 per month math and your Monday morning plan. Here's how Diane splits her portfolio. 55% in VOO for growth, 30% in SCHD for income, 15% in IQLT for smart global exposure. The blended dividend yield across all 3 funds is roughly 2.0 to 2.1%. To generate $1,500 a month from dividends alone, Diane needs a portfolio of roughly $900,000 to $1 million. That sounds enormous until you see how compounding works in her favor.
If Diane invests $1,200 a month at a blended return of about 9% per year, here's what happens. After 5 years, she has roughly $92,000. After 10 years, about $243,000. After 15 years, her portfolio climbs to around $490,000. And after 20 years, at age 67, Diane crosses $900,000. $1,200 a month, that's about $40 a day. One dinner out, one forgotten subscription, except this one compounds.
Now, here's the number that surprised me. If Diane waits until 52 to start, just 5 years later, she would need roughly $2,100 a month to reach the same target, nearly double the monthly cost. Same goal, same 3 ETFs, but 5 fewer years of compounding changes everything. And here's what makes this system fundamentally different from chasing a big portfolio number. Once Diane reaches that $900,000 range, the income doesn't stop growing. Because SCHD's dividend grows at roughly 10 to 11% per year, her $1,500 a month income becomes roughly $2,400 a month within just 5 years of retirement. Her income rises even after she stops working. The blended expense ratio across all 3 ETFs is about 0.08%. That's roughly $80 a year on every $100,000. A typical advisor-managed portfolio charges 1% or more. On $900,000, that's a difference of over $8,000 every single year staying in Diane's pocket, instead of leaving it. Now, the system works, but only if you avoid 3 quiet killers. Killer number 1, yield chasing. Some ETFs advertise 7, 8, even 10% yields. Behind those numbers are often unstable companies and unsustainable payouts. When the dividend gets cut, the share price collapses with it. SCHD's quality screen exists specifically to keep those traps out. A growing 3.3% beats a shrinking 8% every single time. Killer number 2, panic selling. The Dalbar report has confirmed it for over 15 straight years. The average stock investor consistently earns less than the market. Not because markets failed them, because they sold at the bottom and bought back too late. The fix is simple. Automate your investments. You cannot panic sell what you never touch. Killer number 3, loading up on bonds too early. If you're 47 with a 20-year runway, locking 40% of your portfolio into bonds earning under 2% per year caps your growth and delays everything. Build the income engine first, add protection later when you're closer to drawing from it. Here's Diane's Monday morning plan. Step 1, open a low-cost brokerage account. Fidelity, Schwab, or Vanguard. All 3 work. Step 2, set up automatic monthly investments split across 3 ETFs, 55% VOO, 30% SCHD, 15% IQLT. Step 3, rebalance once a year. That's it. No daily checking, no chasing headlines, no tweaking every time the market dips. Complexity feels smart. Simplicity builds income. Diane's portfolio went from 9 funds to 3, from $310 a month to a system targeting $1,500 a month and growing, from confusion to a plan she can explain in 1 sentence. If someone you know has a cluttered portfolio and doesn't know where to start, send them this video right now. It could save them years of drag. Tell me in the comments, what's your current monthly dividend income? Even if it's 0, I want to hear it. If you're building a retirement income stream and want to stay ahead, subscribe to this channel. I break down exactly what protects and grows your income.